Let's get some context. Mohamed El-Erian is Chief Economic Advisor at Allianz. He says the Fed must signal the start of a rate-cutting cycle soon to avoid a costly policy mistake. And he joins us now. Mohamed, always a pleasure to have you on the show. That's a bold call, pushing the Federal Reserve here to signal that they're more concerned about the outlook than perhaps they have suggested. Talk me through why you think they need to do this, and then we'll talk about the catch-22 that presents.
It's very simple, Julia. The markets have already priced in three rate cuts this year, and they've done so on account of three things. One is concern that the trade tensions are becoming even less predictable because of what happened vis-a-vis Mexico last week. Two, the European elections mean a more fragmented regional and national political landscape, harder to implement pro-growth policies. And three, the own dynamics of the bond market. And the concern here is, even if it's not justified by the US economic conditions, if the markets don't get a rate hike, they'll have a huge tantrum that will then contaminate the economy.
I mean, that's a huge problem for the Federal Reserve to have to face down. They have to do what the market's telling them or risk the market having a tantrum because they don't get what they want. Is the bond market getting this right, whether it's the inversion of the yield curve and the risk that that perhaps either does or doesn't suggest some kind of broader slowdown and a recession risk here? What is the market getting wrong and what's it getting right here in your view?
So I think the market has been conditioned through the last 10 years to expect the Fed to be their best friend forever, their BFF. And when they don't see the Fed reacting quickly enough, they force the Fed's hand. And that's been the story of the last few years. It's not a good story. You want the Fed to lead the markets, not to follow the markets. But unfortunately, this codependence has gone too far. And now the markets risk a self-fulfilling problem. And that's one thing that I think that the Federal Reserve doesn't yet understand well enough. And it's like you say, it's a very uncomfortable position to be in.
Do we need the Federal Reserve and Jay Powell to suggest that this week? Because Jay Powell does have an opportunity to perhaps indicate, look, the trade risks here are perhaps greater than we initially thought.
So this is a really hard question for me to answer. If you look short term in terms of market stability, yes, we need Chairman Powell to indicate this week. If you look longer term, at some point, you've got to get out of this unhealthy codependence. So I think at the end of the day, the Fed will do it short term and will do what previous Feds have done, which is simply kick the can down the road.
Where does this unhealthy codependence between the markets and the Federal Reserve end? Because we could argue that compared to other developed market central banks, at least the Fed has managed to hike 9 times. It has some cushion for the next slowdown. That's a very different story elsewhere in the world.
It is. And as much as we talk about the Fed, we should be spending a lot more time talking about the European Central Bank. They face an even tougher policy outlook. First, the economy is much weaker. I worry about what economists call stall speed growth, which means you're not going fast enough to maintain enough momentum. Secondly, let's not forget that interest rates are already negative in Europe. Thirdly, the ECB is going through a major leadership transition. So as much as we worry about the Fed, Julia, remember the ECB. Their complexity is much higher than that of the Fed.